better place. We are smart at what we do to make our world a better place. By the help of God, to make our world a better place. By the help of God, to make our world a better place. Smart do.
Hello students, today I want to take you through financial statements. Hope you are all fine and welcome. So financial statements, these are things that are prepared at the end of a business period. So a business period may be 1 year, 6 months, 3 months, 5 years. It depends with individual business. It can even be within a day. For example, those who sell the groceries, they may decide to do it in a week. So at the end of every business, all accounts must be balanced off. All accounts. All accounts balanced off. Another one is that trial balance is extracted. Third one, you will need to prepare profit and loss determination of profit and loss. And lastly, we have the balance sheet prepared. So in light of that, we have determination of profit and loss. So every other business has got an aim of making profit. So without making profit, then the business is not actually doing its objective. So it is very important to determine whether you have gained a profit or you have made a loss. So we are going to see what is actually entailed. Normally, profit, when we were told, is the positive difference between buying and selling. And now we want to see the broader perspective of buying and the broader perspective of selling. For buying, we are going to call it purchases. And for selling, we are going to call it sales. So net sales will be gotten by is equal to sales minus return inwards. What are return inwards? These are goods that you sold the goods to somebody, but apparently there are some part of the goods that they did not want. So they have decided to return them to your business. We also have net purchases. Net purchases, which is equal to total purchases plus you add it to what we call carriage inwards, that is the cost of transportation. Then you subtract what we call return outwards. You take out return outwards. These are goods that you have returned to where you bought them because you don't need them in any way. And then you may need to also remove those that have been used by the owner, which we call drawings, so less drawings. So for you to know what is profit or what is loss, net sales, which is going to be found by sales less return inwards, then we are going to see net purchases, which is gotten by purchases plus carriage inwards, less return outwards, less drawings. let's see now how to get the gross profit. So gross profit is found by the difference between the net sales minus, guess it, minus the net purchases. Net purchases, of which all this is captured here and all this is captured here. So let's see what we called net purchases. Net purchases are basically the cost of goods sold. Net purchases are cost of goods sold, which can be abbreviated as COGS. Yes, we will be abbreviating it as COGS. So let's see what net profit is. This is gross profit and this is net profit. So gross profit is equal to, after getting the gross profit, we calculate for the net profit, which is equal to gross profit less total expense. Total expenses. Now, we can move to trading account, having seen all this. So we move to what we call trading account. So trading account is basically used to determine whether the business has gained the gross profit. So its main purpose is to determine whether the business has gained net profit. Under it, we are going to have a heading, which is the name of the business. We start with the name of the business. Name of the business. Followed by trading account. Trading account. Remember, our aim is to get to the gross profit, which is net sales less the cost of goods sold. So we will have a T table. This side is debit, this side is credit. So we are going to, on the debit side, we are going to add all the purchases or everything that is that pertains the purchases. So we are going to have, normally a business may be conducting itself and conducting maybe accounting per week. So last week we had some goods that we have brought down. So we will call that opening stock. So we start with opening stock. Opening stock. Then we will add purchases. Add purchases. Then we will add carriage inwards. Then we add carriage inwards. Excuse me. Okay, we add carriage inwards. As you can see here, add carriage inwards. Then what are we doing? We less return outwards. Less return outwards. Up to here, now that this one has been of benefit to us, allow me to delete this one so that you can continue. We can continue having more space to write. Then we have now less drawings. Less drawings. Then now we will obtain what we call cost of goods available for sale. Cost of goods available for sale. Before I go that, because I want to use this to curate something over here. I say that on the credit side, we are going to record anything that is that pertains sales. So we are going to start with sales. Then we are going to less return. What is net sales? Sales less return inwards. So less return inwards. Having used that, I can now delete it without fear or favor. Then, now after obtaining cost of goods available for sale, I'm going to less closing stock because it is part of the goods that are remaining with. So less closing stock. And after that, I'm going to obtain what we call cost of goods sold. Cost of goods sold, which is also known as COGS. COGS. That way. That is my end at that point. So on the other side, I'll obtain what we call net sales here. Net sales. And after obtaining net sales, I'll know what my gross profit is. So gross profit, they must balance at a point. So here and here. So I have what we call gross profit, which I will bring down. So on this side, I'll add and see what I have. And on this side, I'll see the figures must be the same. After that, you will carry down the gross profit, which is here now. Gross profit carried down. Next time we will see an example. I hope you enjoyed. Thank you.